Welcome everyone, another great video. We're continuing our chat on the RRSP Meltdown.
Exactly.
We have a great question here from Curtis. We'll put this up. The question is, he's withdrawing from his RRIF. He's doing the RRSP Meltdown.
Yay!
His TFSA is all maxed out, so he can't put it there. So he puts it into the non-registered account. But that does create another tax burden. What do you do? And that's the problem that we're looking at here, is that non-registered account.
It is. And most taxable income from your non-registered investments, I mean, so if you're getting taxed on that, it means you're going to take less from your RRIF or your RRSP, whatever the case may be.
It minimizes the effectiveness of your RRSP meltdown strategy because you got this extra tax burden trying to deal with. So the solution, what we're going to look at,
is asset location. And the reason for that is it depends on your tax situation. Now, your taxes are going to depend on what you've got it in. So anything that's in your RRSP is going to have a certain tax, or your RRIF. Anything in your TFSA we know is not taxable. And in your non-registered, well, that's where things get tricky. So basically, if you got a RRIF, a LIF, PRIF, an RRSP, anything you take out of that is taxed as pure income. That is pure income, as though you earned it yourself. If you're dealing with the non-registered, that's where it gets a little more tricky. If it's interest income like a GIC, that's taxed as though it's regular income. If you're getting dividends from a stock, such as a bank, that's going to be taxed differently. You're going to get capital gains if you've got a gain in them. Or there's the return of capital aspect, which basically is a delaying scenario for taxes not being paid now but being paid at a later date. That's sort of the area. And of course, the tax-free, we know, no tax at all.
It's completely tax-free. Yeah. So this is the crux of the asset location strategy, how it can lower the tax bill in your non-registered account. And that could, of course, help with your RRIF withdrawals. And the idea that each investment could have a different type of tax, that's really what you're playing into here. Quick example, we just picked a marginal tax rate. We picked 43.4%. Really, if you're in a low tax bracket, this isn't an implication.
No, it's not going to happen.
Only if you're in a higher bracket where this starts to make more sense. That's why you picked a larger number. But your interest income, say you have a GIC or bond, pays you interest, that's fully taxable, the full 43.4.
That's what you're paying on it.
You have a dividend, you do get a break. There's a dividend tax credit. So you can see that number is at 28.12%.
That's right.
Then you get your capital gains, a return of capital. They're taxed similarly. You don't pay the tax right away.
Nope.
You pay only when you sell. So if you don't sell, there's zero tax in that year. And you sell, say, 5 years from now, you only pay the tax 5 years from now. So you get that deferral. You do not get the deferral with the dividend or the interest. So
that's
one benefit,
every year.
Deferral plus a lower number. Now we have to have a little wrinkle here. They changed the rules a few months back. So below 250 of capital gain, 21.7%. Above 250, a higher number, 28.9%.
Yep.
But this is the crux of that asset location strategy for that non-registered account. And we'll do a quick example here. You got your three buckets. Call it your RRSP, RRIF, or any of that alphabet soup. Your TFSA, and then that non-registered bucket.
Yeah, so if you see, I mean, right now we've got them all sort of aspect where you've got some income, you've got some return of capital, and capital gain, you've got some dividend.
All of them.
Yeah, exactly there. But the way to do it differently is, where am I going to put the best investments for that? So, I mean, if I want something that's earning pure interest, probably my TFSA, because it doesn't matter when I haul it out, I never have to pay tax on it. That's always a positive to deal with it that way. Same sort of thing can happen at the beginning in your RRSP if you want. But again, if you're looking at that non-registered side, you want stuff that earns more of a capital gain, more of a return of capital, even stuff that's more of a dividend scenario, because you're going to be paying less tax that way. And if you've got investments where you can get income that's less taxable, you can draw more out of your RRIF going forward.
That's the whole concept here. So Curtis's questions, hey, I'm trying to do that RRSP meltdown. I heard about it, saved me a lot of tax, but I have this non-registered account which is creating tax. So how do I minimize that burden so I can take more out of my RRSP and RRIF and really draw that one down? Well, here's one solution, the asset location. You put the investments in the non-registered account that are going to have the lower tax burden, the return of capital, the capital gains, even some dividends. You're at the lower tax burden there, which allows you to really chunk through that RRIF, chunk through that RRSP, and minimize that, because that'd be the higher tax liability. That's the whole concept there. That's how Curtis can solve the problem that he brought to us. However, you have to have a few considerations.
There is.
Always trade-offs. There's nothing perfect, and one of those considerations is risk.
And that's a big factor to look at. I mean, remember, everything that we tie, the reason you're getting that tax break in the first place is because you're taking more risk in your investments. That's why the government's giving you these breaks. So if you're not really that risk-oriented, putting all this risk stuff in your non-registered may not be the smartest move. So you have to be comfortable with your risk trade-off to be able to get that sort of a tax break. And that's one of the big factors.
It is.
Yeah. So you've got a withdrawal from your non-registered account triggering. It makes the strategy less effective going forward. And of course, we're not just dealing with this. There's other factors that we have to look at.
Yeah, there's quite a few factors. A quick recap, because we want to make sure we get all the info here. Watching the risk, that you talked about.
That's the big one.
That's a key one. So not all investments have the same risk. So even if the capital gain strategy has a better tax incentive, you're probably taking more risk with that investment than, let's say, a GIC.
Yep.
So you have to keep that in mind. And then the withdrawals is key, and that ties it to our Becker Orr model of having a plan. If you're taking money out of this non-registered account, well, when you sell the investment and then you put it in your bank account and you spend it when you sell the investment, you'd be triggering the capital gains, which defeats the whole purpose of the strategy, because now you're triggering the tax as opposed to deferring it and using that time period to draw down your RSP or RRIF.
That's right.
So if you're withdrawing regularly from this non-registered account, different plan altogether. And that's why it really has to work within the structure of a larger plan. And the last piece here is the account sizes do matter.
They do. I mean, you have to have a big enough account size to be able to do it. If you've got a small TFSA or a small RSP, then you're really not doing anything where you can take that money out. It's not a big factor. And remember, taxes should not drive your investment strategy. They should help, but they shouldn't drive it. So the size of your account is going to have a big difference. If you've got a large portion in certain areas where you're taxed, that's something that you have to consider. Again, if you have questions on this one or anything else in the RSP Meltdown solution, they should go to
chatwithclintonkevin.com, part of our website, chatwithclintonkevin.com. Little form there, fill it in, comes right to us, doesn't go to a junior advisor or anything of that nature. Kevin and I do see those emails, and we do reply, and we appreciate this. Like Curtis reached out with a question, you can do the exact same thing. So please do visit chatwithclintonkevin.com. One final point here, you mentioned account sizes, that third consideration. Account size in terms of the size of the RSP and TFSA.
Yep.
So if it's a really small RRIF, well, you probably don't have to worry about this problem.
Not at all.
Also the size of the non-registered account. If you have a really big non-registered account, you say, hey, I'm going to move all of this to just capital gain strategy. Well, you've probably really increased the risk of your portfolio by having that much of a chunk in stocks or higher risk investments. Likely not a great idea. So keep the overall portfolio in check. So the size of the accounts matter there as well. If you like this video, we've got lots of others, including the one floating on the screen right now. Click on that guy. We'll see you again very soon.
Take care.